Welcome, everyone, to another exciting episode of the YouTube show and podcast, None of Our Businesses, where three accountants today are talking about business, news, taxes, accounting, all, of course, from an accountant's perspective. With me today, AJ Wheeler.
How's it going, everybody?
And Charlie Zygmunt.
Thanks for joining us.
I'm Ty Carr, and here's a look at what we're going to be talking about today. From Japan, is a 4-day work week the way to go? Restaurants hiring robots if the workforce doesn't return. What should the tax treatment of NFTs be? Bitcoin trader brothers pull off crypto theft and vanish. And finally, accountants are service providers. How do you think about bad news? Well, hey, if you enjoy this podcast, this YouTube show, be sure to tell your friends, your colleagues about it. We'd love to grow the audience. Give us some ratings on the whatever channel you're watching us on, and the thumbs up, subscribe, all of that good stuff. Put something down in the comments if you have questions or things you'd like us to address in the future. Perhaps that'd be something we can pick up on. Thank you. And with that, we'll get it going with Charlie.
All right, so I found an article we can talk about today from a source called the Mainichi, which is a Japanese news publication, and it's called Japan Government Backs 4-Day Work Week, but Experts Are Split. And so what's happened is that there is an annual economic policy guideline that gets finalized by the Japanese government, and this happened Friday. And in that, the government makes a plea to employers to consider allowing their employees to work, to have the choice of whether they want to work 4-day work weeks or 5-day work weeks. And the subject of the article is that they've asked experts on whether or not they think that this will be widely accepted. Some proponents of it say that the 4-day work week will cause people to be more motivated and would improve productivity and would allow them to attend to family matters more easily, while others say that they fear that wages will just cut proportionally to the hours drop that occurs, and that it won't actually lead to kind of more motivation or to any of the hoped goals of a 4-day work week. I know that for us here in America, it's very normal that we've kind of become accustomed to a 5-day work week, but I've heard a lot of positive sentiment towards a 4-day work week as well. And so I kind of want to get your guys' opinion on, other than what we're actively doing now, can you kind of see any of the arguments for why a 4-day work week might be better, or are you more of a fan of the 5-day approach?
I don't think there's anything magic about a 5-day approach or a 4-day approach. I've adopted in my own life, you hear people talk about work-life integration as opposed to work-life balance. And I think I've embraced that as a lot. I do get to kind of disconnect a lot on the weekends, but I think me disconnecting from work on the weekends has more to do with the fact that everyone else disconnects. And so in my work-life integration, because I do the things I want to do throughout the week, as well as, I attend to family matters throughout the week. I enjoy gardening a lot, if people didn't know that, and I do that throughout the week. I do more of some of the gardening and family time on the weekends because I have less work popping up. But I think the reason that I have less work popping up on the weekend is because everybody else is shut down for the weekend, and I'm trying to respect that as well. And I think that, and so that leads me to my main point, which is I think what's magic about any of us individually as it stands today, working a 5-day work week, is that that's what the rest of society does. And so what's really kind of what the real magic is working during a time that everybody else is working, your other teammates in your company, your vendors, your customers. It's really higher level business is about higher level collaboration. And it's hard to collaborate if you are on some kind of oddball schedule that is way different than anyone else. And I think to me, that's the primary issue. So I think if, as a society or a country for that matter, if you just said, well, we're all going to do a 4-day work week, I think it could work well in the sense that, everybody else is kind of doing the same thing. And so you're set up for, to harmonize the collaboration time with each other that way. But I think, whether it's a 5-day, 4-day, whether you work nights or whether you work mornings or whatever, any of that. There's no like magic formula to that, other than it doesn't work well if you're not able to collaborate with your vendors, customers, and peers.
Yeah, Ty, and I actually found the article really hard to believe that they would make this. I actually lived in Japan when I was younger, and the work culture in Japan is much different from like the work culture in Europe to the work culture in like America. Companies there and the work culture in Japan is very like tight knit, hierarchical, long work hours, very dedicated work. Like staff, managers, and all that. And there's like a real like dedication to work in that. In fact, some companies, when you take vacation, you vacation with your work buddies and not your family. So, I mean, it's a very different work culture from what we're used to in the Western world. And so I had to look up some like stats. And in fact, a 2016 government survey found that over 25% of all Japanese companies demand 80 hours of overtime each month. So, and then you contrast that, on average, 22% of all Japanese workers work more than 50 hours a week. Compare that to the United States, where only 11% of employees work 50 hours a week. So it's a very different culture. I think they can put this out as like maybe like, because you contrast that and like the level of like disappointment in life, I guess, or however you measure it, if is higher in Japan, and they try to correlate that with such a strong work culture where, if you're working 80 hours of overtime in a month, I mean, you don't have much time for anything else, So I think what Ty talked about is correct, especially in America when we think about like work-life balance and how everybody talks about it. But I think it also depends on what industry you're in. If you're a service-based industry or a consultant like our company is, you really have to work around the schedule of everybody else and who you're collaborating with and who you're consulting with and who you're doing outsourced things for. But like, for instance, if you're like, I don't know, a tax preparer firm, if we're going to keep it in the accounting realm, you're really working on the information that everybody's giving you, and then you're preparing that on your own time. So if you want to do a 4-day work week and do 10-hour days, that might be acceptable as long as your clients are okay with picking up their tax returns or dropping off their information Monday through Thursday or whatever it is. But if you're like, I don't know, a 7-Eleven, I don't think you're going to get away with a 4-day work week for all of your employees, if it didn't sketch out that you're open 24/7, So I think it really, like, there's a lot of factors to this. And I don't think you can just stamp, like a 4-day work week is great for everybody. Like if you're in a manufacturing setting, maybe it is, because you're allowed to control your own production schedule. If you're the higher ups in that company and say, okay, everybody's going to work 4 days a week, and then you have a 3-day weekend, or we hear about like the firefighters that have, like 4 days on, 5 days off or whatever it is. Well, that's different. You're on 24 hours a day for 4 days, and then you get, 5 days off or 3 days off or whatever it is. So I think it really depends on what service or industry you're in and what you're offering to your clients. And then it also depends on, the employees and the company's appetite for difference in those hours, work hours being available hours, and what you're offering to the public, So, and then it also depends on the culture of where you're at. Like I talked about, there's a difference between Western culture in America, European work culture, where they often have 4-day work weeks, 1.5-hour lunches that cut out half day on Friday or whatever it is that they do in Europe. And then you have like this Japanese model where they have a very cultural pride around working overtime, very hard, very diligent, very like long hours and dedication to wherever you're working, and a very hierarchical kind of pyramid type top down kind of situation. So one size doesn't fit all in this case. And I think, the more options that are out there, I think it's better for everybody. You can hopefully find something that fits your kind of, work-life balance that you wish to achieve at where you're at in your life. And then hopefully you can mirror that in wherever you're getting employed.
Yeah, I think you guys have it exactly right. And the article talks a little bit about how it's important for companies to make clear what they intend in adopting such a system. And so, like you said, it's like if we're gonna do something new, we have to be on the same page about it. And so we want to be clear on why we're even doing this. And yeah, I think you both bring up some good points on that. And it'll be interesting to see if what Japan does sets any kind of precedent for what the rest of the world ends up doing. All right. Yeah. So you said you had an article we could talk about, right, AJ?
Yeah, I got one. This is from Business Insider India, of all places, but it says restaurants are starting to hire robots instead of people who are demanding higher pay. So just, I guess, the opening line to this is 10% of job seekers are urgently looking for openings, according to a recent survey. And whether it's virus fear or just, a slow return to work after the pandemic, they're talking about that this has had a major impact on implementing robotic services for or automation via robots and AI to businesses. So economic data suggests that a shift to automation has been underway for months now. Productivity surged 5.4% in the first 3 months of 2021, and it's the fastest rate of improvement in more than 20 years. And they point to adapting new tech, largely in restaurants, have sheeted away from that automation will replace workers. And this is something that we've talked about on the podcast before when we've had articles about, like minimum wage workers, I guess, or restaurant workers, demanding or asking for $15 an hour wages, a living wage to work at like a restaurant. And essentially I propose, and I think the podcast proposed, that if this was, pushed forward through mandate or, push came to shove where people would not accept jobs at a lower rate than $15 an hour, that you would see an influx of automation happen, especially in like what I guess society considers as lower tier jobs in like the food industry. You've seen it in supermarkets where self-checkout lanes have replaced a cashier being there. So there's been a slight change or shift over the years. So I'd like to get your guys' take, and and I think this article is kind of speculating using some kind of metrics that have been gained over the first few months of 2021. But I think it's like kind of validating what we've kind of said in the past on the podcast, where if you make this push for higher wages, it's going to be replaced by automation. And the article kind of says that those automation jobs will create jobs through the maintenance and repair of those, machines, I guess, that are replacing normal workers. But I don't know if that shift is going to replace a one-to-one comparison for the low-paying jobs to shift to like a repair job for those implementation of AI and robots flipping burgers, for instance. But I'd like to get your guys' take on whether or not you think this is something we'll see more of, or is this like a knee-jerk reaction to the slow, I guess, reintroduction of employees and opening after the pandemic?
I mean, I think the article's premise makes sense. The necessity is the mother of invention. And so the longer that the labor force doesn't return to jobs and there's a demand for goods and services, then, I mean, it totally makes sense to me that similar to how the pandemic spurred more people starting to use video conferencing technology. The technology was there for a while, and people just weren't adopting it because it was too convenient to do things the way they always did it, right? Until it just wasn't convenient to do it that way. So I think that's a great lesson in what happens in the market economy that we have and in the business environment, is that if you can't, if you have a need and a demand to fill and you can't do it any other way, companies will find a way to do it, and robotic technology could be the answer. I think the catching point will be, while companies may try, is the technology really up to par yet? Is it really able to meet the underlying need that people really have? I think we see this right now. You go out to eat, and there's some restaurants, as we're sitting here today, capacity limits have been lifted where we are in Oregon, and they've been lifted, and the mandates in Oregon have been lifted and stuff like that. And I think that's happened in a lot of states. And so what we're seeing, and you see this in reports, and I've seen it myself, is you go into restaurants and they're still basically putting some kind of artificial capacity limits on themselves because they don't have the labor to serve you. I had a restaurant, for example, I went into the other day that they said, well, our inside seating is maxed out, it's full, so you can't sit inside, and that's where we have dining service, but you can order at the counter and wait your own table outside, and we've got plenty of space there. And you could tell, well, what that was about was they didn't have enough servers, right? That was the issue. So so I think, and so I think about that. I'm like, okay, would my wife and I, would we still go out to eat if the experience was known that we probably weren't going to have a human server, we were just going to be served by some kind of robotic technology? Would we still do that? And I think, yeah, I'm not sure. Like, we wouldn't be getting the same experience or not, right? So I'm not sure. I think that is the bogey in all this: is, does that robotic technology actually replace the human touch in what you do? Plenty of people go through drive-throughs. Plenty of people use do takeout and things that where they get their food made for them, but it's not in a sit-down service kind of situation. So I think there is proof that if you make the service delivery something other than a human server, it still works, that it does still meet some sort of demand. I'm just not sure if it's the exact same or entire demand that there is for human servers, as just an example. And that's just one industry and one example that we're honing in on, right? I mean, obviously, I think what you're talking about has broader implications. It could also be the number of people that are in the Home Depot or other places to provide service to you. So yeah, those are my thoughts on it.
Yeah, no, I think that's exactly right. And yeah, I think like an interesting example, like you said, it's just different. An interesting example of this would be like vending machines. I mean, they've been accepted and they're all over the place. And there's more and more things that you're seeing move to vending machines, including electronics and that sort of a thing. I've even seen those in malls and whatnot. And so people find some need for that. But like you said, it's not a replacement for speaking to a salesperson about an electronic that you might buy or some other product that you would otherwise get. And so, yeah, I think anytime we see these changes towards automation, we see a shift of how the work is being done, whether it's, like you said, repair work or that kind of a thing. And so I try not to get too up in arms about an industry going away, because it kind of feels like every advancement that we've made in any way has done damage to some prior industry. I mean, when we, automated the printing press, that did damage to that industry, and you could come up with a million examples. But at some point, we just stop having sympathy for these ways of yesterday. And I don't know that we're there yet on this one, because we're still actively using in-person services, but it just seems to me like we should be more accepting of change of this nature, just because that's the way of the world. That's been the case for many years. So, yeah, that's my thoughts.
Yeah, I think you're right, Charlie. And I think my personal take on this is I think we'll see, I think we often think of automation and AI as like a binary choice, right? Whether it's customer service or robot service. And I think you're going to see kind of a mesh of that. And I think the best kind of example of that, if we're talking about the restaurant industry, are these like sushi boat, like chain, where the sushi comes around on a conveyor belt. You have somebody there making the sushi for you, and you have a server that you can interact with if you want something that's not on the conveyor belt. Not that this is the best sushi in the world, but it's an option. And so I think you're gonna see a marrying of, like, you can't just let robots flip burgers all day. They're gonna catch on fire, or, I think you're gonna have to have some kind of oversight of the machines and the AI in a situation like that. But I think, it's instead of being a 1 or a 0 and a binary choice between human service versus machine service, I think you're going to see a marrying of, like, if we use the Home Depot example, right? I don't know how many times I've been annoyed by some guy in plumbing. Hey, do you know what you're looking for? Let me help you. I'm like, no, I've done this before. I don't need help, but I would like to find, somewhere where something, maybe a robot, could point me to the right part, and then somebody there if I need assistance to be able to call in that situation. So I think if you're asking for my prediction, I think you're going to see not a 1 or a 0 in this, a binary choice between machines or people. I think you're going to see them marrying, just like Charlie's explanation of the printing press. You can have an automatic printer, spit out newspapers, but you need somebody there to make sure that the thing doesn't catch on fire and it's not printing swear words that somebody else like put in there. So, I mean, like there has to be some kind, at this point in our technology, there needs to be some kind of human interaction, I think, or human oversight in these machines. And I think you're going to see a marrying of that, kind of come up. And so, yeah, machines may replace burger flippers, but there needs to be somebody there to make sure there isn't a grease fire, right? So, Ty, you got another article for us?
Yeah, this one that I got out of the Journal of Accountancy gave me a little bit of insight to something I've been wondering about. NFTs, non-fungible tokens. As I said, this came out of the Journal of Accountancy, and the question they were looking at is what would the taxability, or what should the tax treatment of NFTs be? Mind you that the IRS has not said anything about the tax treatment on NFTs. So the authors here are making analogies and somewhat speculating on what the tax treatment would be. But I think their speculations are pretty solid, and that's what you would have to do, right? And I think it would be dangerous for a taxpayer to just assume that NFT transactions are wholly non-taxable or have no tax effects whatsoever. You're better off doing exactly what these authors did and applying a good understanding of existing tax laws in the best way you can, so that when the day comes that the IRS does kind of weigh in, you're not whipsawed by doing something that's wholly different than what they would do. You're probably, if you kind of have a guess ahead of time of what the treatment would be, which you can kind of guess based on analogous rules and situations, then you're going to be in a better position tax-wise than if you just ignored it and stuck your head in the sand kind of thing. So I'll get off that high horse and just talk about the issues involved here. One of the first obvious questions is, what is an NFT? I think maybe some of our audience just knows much better than I do. And there are some real NFT nerds out there as well. Dare I say, Charlie might be a little more of an NFT nerd than I am, but we'll see what he has to say about this as we get into it. But I like the way the article described NFTs. It described, it talked about NFTs as kind of taking digital assets, and you imagine that digital assets, digital work, whether it's a song or a picture or a video or it could be anything that is in the digital realm. We all know that it can be copied many times over, and that everybody out there can get a copy of some kind of digital piece of artwork. You getting a copy of it is not a hard thing to do. And even if, there's been schemes in the history of the internet, there's been all kinds of schemes to try to lock things and put things behind paywalls, but we all know that stuff gets pirated and stuff anyway. So the practicality of, putting out a song on the internet and making it so that only the people who paid you get to listen to it is pretty far gone as far as the practicality these days. So what NFTs seek to do is they seek to accept this notion that a digital asset or a digital piece of artwork is basically going to be copied the world over, and that you're not gonna keep it private when it's on the internet in any way. But what you can do is you can essentially put the equivalent of your autograph on it, and you can make something that is ubiquitous and has many, many digital copies. You can actually take something like that, and you can identify a version of it. You can identify a singular digital version of that thing as an original, as if the artist had autographed it. And that's what the non-fungible token is, using blockchain technology, which is the same technology that is used for cryptocurrencies such as Bitcoins. These NFTs seek to create some uniqueness to a particular digital asset, which otherwise the other attributes of that asset, like what it looks like, what it sounds like, is easily copyable. The token, the NFT, is not. It is verifiably and secured to whoever that owner is of the NFT. And so that's kind of a brief concept of the NFT as far as I understand it from looking at how it was written about in the Journal of Accountancy. So true to our show here, it is an accountant's description of the NFT. And so I liked another term that the Journal of Accountancy article used was they referred to NFTs as a crypto asset, right? Like if Bitcoin is a cryptocurrency, then NFT would be a crypto asset. And as an asset, you think about from an economic perspective, most assets or all assets that we think of from an accounting perspective, which we also think of from an economic perspective, assets can have gains, they can have losses, they can generate income. And when you think about that, those are economic events that can affect one's wealth and therefore would have some sort of tax treatment to them, right? So anything else in our world that has gains or losses or generates income affecting our wealth has a taxable effect to it. So you would be wise to presume that the same would be true for a crypto asset as well. So the journal authors speculate that NFTs would be treated as a form of property. And indeed, the IRS guidance on cryptocurrency is that cryptocurrency should be treated as a form of property for tax purposes. So it seems very, very likely and very reasonable that that is the correct position for tax purposes for NFTs. So, you know, what the article, I won't go through all the details. The article, I would encourage you to look at it. We'll put it in our show notes in the description, a link to it as we do with other articles, as we always do on our shows. But I'll just go through, there's kind of 5 economic events in the life of an NFT that could have a tax consequence to it. And then you'll have to go to the article to kind of get more details on those events and the explanation to the potential tax consequences. But here are kind of the 5 economic events that I pulled out of that article that could have tax consequences to them. And so the first, or not, right, that you can think about, I guess, is what I should say. So the first one would be simple NFT creation. And I would say that the creation of an NFT, what the article talks about, and what I would agree with, is that the sheer creation of an NFT from a work of art or attached to a work of art probably would not be taxable or shouldn't be taxable, even if you can acknowledge that the act of assigning an NFT to a work of art creates value or wealth in that work of art, because it creates something that is unique to it that can be monetized. So just that act alone arguably does create wealth. We'd say normal tax principles wouldn't tax that kind of thing. You would normally wait until that extra value is captured with an eventual sale or exchange of the property, in this case of the NFT. So I would agree with the article in this point that the creation itself of an NFT is probably not a taxable event. The second economic event that the article addresses is the NFT's use in a trade or business. And they talk about this in a couple of ways. On one side, one of the ways these NFTs are being used and are envisioned to be used is that they can create a royalty stream or a percentage cut of the future sales proceeds for the artist. So when that piece of art with an NFT attached to it gets sold, and maybe it gets sold to somebody, one person, and then that person sells it to somebody else, and that person sells it to somebody else, there is a process, there is a capability there that can be tracked, and in a way that a percentage of those sales proceeds can be attributed back to the original artist, for example. So that's kind of a cool thing, right? An NFT can be set up so that somebody who has currently using the NFT is essentially renting it. They have to pay royalties to the original artist to keep that NFT in their possession, or to keep it as theirs, kind of thing. So that would create an income stream to the artist as well. So, obviously those kinds of schemes would create taxable income consequences. I think that should be obvious to people that there would be taxable income there. And so to simply ignore it would be very dangerous in terms of your tax positions. It also seems reasonable on the other side, though, that if you are a business that in the context of your business for some reason purchases an NFT, that because we're saying NFTs would be similar to other property, it seems like the purchase cost, whatever you paid to buy that NFT, should be somehow deductible on your taxes through a process of depreciation or amortization. So I would expect that would be the case as well. And the article goes into more details about how that could be with Internal Revenue Code sections and so on. So I think that's a cool thing to keep in mind. The article also goes into something else, which is in that vein is, if you're saying you have a business that purchases NFTs and then you're trying to deduct those costs in some way, stop and ask the question, well, what kind of business is this? Is it really a business that purchased the NFTs? Because you could get caught in a black hole there, in the sense, or you can get caught in a pit, in a trap, I should say, there, in the sense that you may be claiming that you have a business that buys and sells NFTs, or that is buying NFTs and holding them or whatever. And it may ultimately be that the IRS looks at that and says, nah, buying NFTs is not really a business. It's more like a hobby. And there's specific rules about when you can deduct your costs related to hobbies. It's not the same as deducting costs related to businesses. So I'd say that's an unanswered question. At what point does buying NFTs or trading in NFTs actually constitute a business if you're trying to track costs and deduct them in that scenario? And then a kind of a third economics event or scenario that we would expect we'd have to address for tax consequences would be the sale or exchange of an NFT. So, if you're selling that NFT, you're getting something back. I think it probably seems obvious to people, if you sold an NFT for cash, whatever you sold it for is probably taxable. Then again, though, if you bought it, right, if you paid something to buy the NFT to begin with, you should have a tax basis, a cost basis in that NFT. So it's not the entire sales proceeds that would be taxable. It's the net. It's the difference between what you got for selling it versus what you paid to buy it. It's that extra gain that could be taxable. And then, of course, in the tax world, it raises a question. If you're going to tax a gain on the sale of property like that, it would raise the question, should this gain be capital or ordinary income? And I'm not going to attempt to answer that question here. I'd say go look at that article. But again, a lot of these questions are not completely answered. They're brought up for food for thought, because we don't have direct guidance on this from the IRS at this point. A fourth economic event that we should consider the taxation on is, what if you make a charitable contribution of the NFT? So you have a piece of artwork that you own the NFT to, and you then contribute that to a charity. Is that even deductible as a charitable deduction? That would be one question, right? Another question, though, is if you say, well, it's a piece of property, I'm donating it, I'm sure that it's got to be deductible in some fashion. Then it raises a technical question as to, well, what's the value of your deduction? How much are you actually deducting off your tax return? Are you deducting the fair market value of that NFT? Or are you deducting only the cost that you paid for that NFT? And that could be a very meaningful question, because let's suppose you're the artist who created the NFT. You may have zero cost in this thing, but it may have a pretty sizable fair market value. And so, if you get a charitable deduction for the fair market value, you have something there on your taxes to really do something with. But if you created the NFT and you never actually paid anything directly for it, in that sense, then you may not have any cost basis to it. So those are the kinds of questions you'd have to wrestle with if you're dealing with a charitable contribution of the NFT. And finally, the fifth economic event that we would want to consider the taxation of is, what happens if an NFT becomes worthless? Well, obviously what you'd like to do is say, my NFT, I paid something for it perhaps, and it then became worthless. So can I deduct that? Can I take a loss on my tax return for the fact that I lost this value, that I lost this wealth? That's a question, but also what's embedded in that scenario is another question, which is, how do you determine that an NFT became worthless? At what point did it become worthless? When do you actually get to take that deduction? And what is the verification that it's actually not worth anything anymore and therefore worthy of a deduction, if that's even possible? So those are kind of the five economic events of NFTs and the related kind of tax questions that it raises. I encourage you to look at the article. And of course, the article ends with the sage wisdom that more guidance is needed. Well, of course it is. That's what we always say when we don't know the answer in taxes. All right. Well, that's the article, guys. What do you think?
I have so many questions, but I'm just shocked that the IRS would want to tax something where somebody gets money for it. I mean, they've never done that before, but but I think it's clear that there's more. I guess for me, even as extensive as that article is, one thing that I didn't see them touch on is if you're the artist creating this and you sell it, and you get let's say you create a digital piece of work and you get $100,000 for it. When you go to, I mean, that should raise all kinds of flags because you're getting some kind of money for something that you sold that's like a digital asset. What's your basis in that? How do you even come up with a basis of like, or cost of goods sold? You know what I mean? Like, is there any guidance on what's your time worth that you put into creating this digital piece of work versus what the market would bear for that piece of work that was sold? I mean, I think that's like a really good question, and then like to Ty's point, is it a hobby or a business? Like if you're, do you have to prove to be able to take that, like, I guess, cost of goods sold or ordinary business deduction on your tax return? Do you have to be like an artist that actually sold things before this? So I think, it raises a lot of questions to me on basis. Like, I guess for me, like, it would be easier the person buying the asset, it's pretty clear what the market would bear. You paid, a fair market value of what you bought the item for. And then if you turn around and sold it, I think it would be looked at the same way like digital currencies are looked at, where your basis is what you bought it for. And then, whether it's a long-term or short-term gain, hopefully it would reflect a capital gain, for like an asset where, like if you hold it for more than a year and you sold it for more, then, your basis would be what you bought it for. And then the difference of the income taxable portion of that would be the amount you sold it for, the difference. But I think it raises a lot of questions, and I think they need to be answered because just like crypto, this is coming fast and furious. NFTs are all the rage. And I think probably the IRS is, not unsurprisingly, like crypto, kind of behind the times and keeping up with rules and regulations and how to treat these things. But I think to viewers of this show or to anybody that's thinking about this or consulting with somebody that's selling NFTs, it's naive to think that these are untaxable. Anytime you're getting money, you're buying and selling things, there's, the IRS cometh, and then they're going to want their cut. And so, to err on the side of caution, I think is beyond sage advice. I think you really need to expect these to be taxable transactions and to expect the IRS to ask about these things as soon as next year. I mean, we saw crypto have, they were probably, slower on the uptake on asking about cryptocurrency transactions 2 years ago when they probably should have been 5 to 10 years ago, when they got on board with this. But it's unsurprising that they're behind the times on it. And I think the article itself does a really good job of, contemplating the different aspects. But even to me, in reading the article, I still have more questions, like the basis of an artist creating the NFT, or, and I think you have better standing if you're somebody that's buying and selling the NFT for basis and what your gain would be. But again, like all things we say on this podcast, please consult with a CPA, professional accountant, lawyer in these situations to figure out what may be and it never hurts to keep good documentation. I mean, if you can show what you paid, how many hours you spent creating the digital piece of art, what you think your time is worth, what other pieces of art that you've made have sold for, I think you can justify some kind of cost of goods sold or some kind of basis in creating the thing from the beginning. But that's just my quick thoughts on this. Charlie, what about you?
Yeah, I'm with you guys. I think you're all over it, and I'm going to kind of echo some of what you're saying, but just to kind of put my own spin on it. I mean, for me, when I first started seeing this online, at first I was like, what is this? What are we talking about? And it didn't even occur to me to think about the tax consequences. But I think that your example, Ty, that you brought up about an autograph being of value kind of really clicked for me on terms of like why this would be considered an asset. And so for me, it's like, I think the first thing is just accepting that it is an asset. And again, we're not giving any tax advice here. We're just saying the way I look at it. But yeah, I look at it as it is an asset because it can be brought to value and ultimately realized into dollars or some other currency eventually. And like you said, I think the act of that happening is an obvious driver to say, okay, well, if you're getting assets, if you're getting cash out of this, then it seems clear. I think the other thing that you guys said that really hits home is to think that you would not pay tax on it is very naive. And even if you think you found guidance that tells you that, I would urge you to think again on that, because as we found with so many of these PPP regulations and whatnot, that things change all the time, and that just because you found a source that says something that you might want to hear doesn't mean that 3 years down the road when the IRS comes sniffing that source is going to hold water. And so, yeah, I think the wise thing is to take it serious, to consider the ramifications, to use general tax principles like when it gets realized, becoming income. I think that, yeah, as far as the costs going into it, that's a tricky one. Admit that you should have a basis if you buy it and later sell it. That does seem obvious to me. But if you're a person who is making drawings and then selling them through this NFT approach, I guess I find it hard to accept that you would value your time into that and then put that as part of your basis until you're later able to prove that you sold it. And so it seems like that there needs to be more guidance on that point. But yeah, it'll be interesting to see how it plays out. And, it'll be interesting to see if the IRS ever really clarifies this in a satisfactory manner, or if this will continue to just be a point of contention as the years go on, because let's be clear, that's an option too, right? Maybe the IRS just won't clarify this to the extent that we would hope they would. So yeah, those are my thoughts on it. I think it's very interesting to watch and see how it all plays out.
I can speak to one technical aspect in terms of the questions that both of you are asking about, does the value of somebody's time get in here somehow? And so I would point out one just kind of mathematical point, which is that in terms of any creator of anything, the value of their time never gets accounted for until they sell it the first time, right? I mean, that's true for us as employees. We get taxed on the value of our time, right? But if you're creating, and so that's why the article really kind of hones in on the idea of this being property, because there is, if you look at analogous situations, there is tax law that covers the situation of what if you wrote a song, for example, and then you copyright that song and you go out and you sell the song and its copyright to a publisher or whoever, right? Whether it's a song or a book or any other kind of anything like that, a patent, anything that could be copyrighted or governed by regulation, there is tax law that governs how that's taxed, and it is taxable. Like you don't have basis for the time you put into it because you never paid tax for the value of that time in the first place. You never got paid for the value of that time, unless you did get paid for the value somehow. Then you would. But yeah. So that's kind of just a brief primer on how the time piece works out, and also just for us here and for our audience, that there are analogous situations, and that's what you have to look at in this kind of thing.
I think that's good to look at. And another thing to think about, it's going to kind of roll into our next article here, is that we're all talking about what happens when the NFT game goes as we all planned it, right? What happens when we make one and we're selling it and we're gifting it and we're doing all kinds of good things here. But there's an article in the Sun UK called Bitcoin Trader Brothers Vanish with 2.5 billion with a B in the biggest crypto theft in history after claiming platform was hacked. And so I think it's one thing to consider all the consequences and ramifications of transactions as we expect them, but as we've learned with this whole blockchain technology, there's a lot of players and a lot of different things going on in this sort of scenario, and so they're not always behaving as we would think they would. And so in this case, there was an exchange that was set up in South Africa by two brothers who basically, they were 17 and 21, just to give you an idea of the ages of these guys. And they set up this exchange and had a bunch of people, transacting cryptocurrency through their exchange. And then they, at some point, decided to go ahead and lay off all of the people that were involved in the back end about a week before. And then they sent an email out to all of the people who were involved in the exchange, basically imploring them not to sue them, and that, that we're working on this issue and that all your money is not gone and that kind of thing. And lawyers in South Africa are claiming that they smuggled funds out by pooling investor cash with other Bitcoin transactions in order to make them untraceable. And so since that's happened, according to the article, the cryptocurrency's value has halved. And yeah, basically, I just think it's interesting because, we use this, people will laud the blockchain technology for its security features and for things that it stopped counterfeiting and these kinds of things. But I think it's just important to think about that the blockchain technology only really manages one aspect of the currency. And that if you then incorporate a series of exchanges that are ran by players with questionable motives, or not even questionable motives. I mean, if you're 17 or 21 years old and you have access to 2.5 billion in any capacity, whether it's yours or through some website you created, I think that puts a lot of strain and pressure on those people. And it doesn't surprise me that leads to these issues that we're seeing of people disappearing. And so I guess I want to get your guys' take. For me, the most obvious question is, if you were 17 or 21 and had access to that level of cash, do you believe that your younger self could have been able to handle the the onus of responsibility that goes along with that? Or should we be expecting this of every kid who's, able to reach that level of access to funds? I don't know. What do you guys think about that?
Well, I think I would hope that my 21-year-old self or whatever would be able to handle that kind of pressure, but I don't know. I was never in that situation. But I think what the article really speaks to me is, and it speaks to our industry, is like good controls around anything. If there's something to be stolen, somebody's going to figure out a way to do it. And so the alternative to that is trying to come up with a control structure. And just because blockchain, Bitcoin, whatever you want to call it, has this like unbreakable code, or whatever it is until they figure out quantum computing. But, that only one person has access to it, or, as long as you have a password, it's safe. And there's a kind of auditable transaction history to all this. I think we're finding, and this isn't the first case to do so, that where there's a will, there's a way. And if there's something to be stolen, somebody's going to figure out a way to do it. And so I think having controls in place and not just relying on a system or, like a password or something needs to be in place to be able to, at least have some kind of reasonable assurance that these things, that there's some kind of backup and oversight into these things. And so I think, just like with anything else, I think it needs to be part of the system that's in place to be able to monitor these kind of things, and not just leaving it willy-nilly to one or two people oversight. It needs to be a collaborative effort. And if you're investing in something, or you're a part of something like this, I think it's prudent to ask those kind of questions and make sure that there's not just one or two people at the top that are able to collude in this sense to be able to take it. Having checks and balances of some kind in place is necessary in any kind of financial transaction that can have repercussions like this. So
AJ said it all. I'll move us to the next article.
All right. So mine, actually, this is a really good article. I don't think the title does it justice. This is from Accounting Web, but how to tell your clients bad news without losing them. So the article at first blush, I thought, was telling them, they owe $5,000 in taxes, how to break the news to them easily. But what the article is really about is talking about what you offer and this is of course, because it comes from Accounting Web, accounting firm focused, but I think it can be kind of leveraged to anybody that has like a service or a type business or even a retail setting. But essentially what it's saying is, and I'll walk through it. So, and her points, and then I'll kind of explain it. But her points are, does your customer service policy create burnout? And she makes a connection between accounting firms and a customer service firm. And I know a lot of times we think of accounting firms offering, essential services, but it's not often thought of as a customer service type of job. But I'm here to tell you that in my experience, and I think everybody's experience, if you take a long, hard look at what you're doing in an accounting firm, whether that be like our firm, we're in an outsourced accounting or CFO advisory type role, or if you're doing the traditional tax and audit roles of a public firm, I think you are a customer service. There's plenty of different places on the block that they can take their tax return or their audit to. And the reason why they're with you is hopefully because you offer excellent customer service. You're responsive and you take into account their time and your time when delivering services. So her first one is, does your customer service policy create burnout? And so what they're talking about is, when often accountants, we don't like conflict. We're risk adverse. And so when a client asks for something, often our knee-jerk reaction is to say yes to that ask. But in you saying yes, is that creating work outside of your scope? Often, even in our firm, even though we're not an audit and tax firm, we issue engagement letters that clearly states the scope of the work that's to be done. And often we find clients push that boundary, or our internal staff pushes that boundary because we want to do more. So it's often good to look at your engagement letter or whatever scope of work you've laid out with a client and understand, is what they're asking within the scope of work that you've set out to do? Because if it's not, you're setting yourself up for a liability and also disappointment with your client if you're going out beyond what you said you were going to do. Tasks that don't interest you. I mean, I think Ty's railed on this podcast many a times that, if you're doing tax returns for, that you don't want to be doing, personal tax returns, but they're part of your portfolio, you need to get out of it. It's the quickest way to create burnout for somebody, is if you're doing something that you really don't want to do. And then the last one that she says is activities with a short deadline that interferes with your planned work. And I think anybody that listens to this podcast has come up across that, where you really want to get something done for a client, but they need to respect your time as much as you respect their time, and not come with a weak deadline for something that needs to be done immediately. So, and it can often be a hard conversation to have it, and saying no to a client is very difficult. So she says the way to do this is define your limits. And one way is, first of all, issuing a letter that, and not compromising your client relationship, but issuing like an engagement letter to set out clearly what your limits and what the scope of your engagement is. Set the stage. So onboarding new clients, to clearly let them know what you're going to do, how you're going to do it, and what the guardrails are there for what you're there to do. And she has a copy of a letter that you can get of what she sends out to her clients. But essentially what she says is communication, meetings, expectations, and requests, and how you respond to all of those should be laid out to the client when you're onboarding them. Being able to gracefully say no. Often, a client will have a knee-jerk reaction, or how to deliver that no in a way that communicates why you can't do it, or the alternatives to how you can do it. So if it's something that your firm doesn't offer, let's say you're an audit firm and a client wants you to do some kind of bookkeeping work or something that would make you not an independent source of the audit, giving them a referral to somebody that does that, responding in the email that lets them know that this is outside of the scope of work that you're able to do for them, but offering them alternatives to your firm for a place of as a resource for what they're asking. And then it often says, prepare with a dress rehearsal. Doesn't ever hurt to run by an email or a conversation with a superior or a peer to know if you're on the right page of thinking about this. And that's something that we do in our firm often. We have conversations before we send out engagement letters. We have a review of those engagement letters and an ongoing discussion with staff and managers on how we're delivering news and we're keeping in scope. So I would suggest everybody take a look at that and say what you mean. Be direct and let them know why it is that you can do it or the implications of you saying yes to this means. So, and then we talked a little bit about deliver a sandwich, meaning give them an alternative. If it's something that you cannot offer them an alternative. In our case, often we get asked if we can prepare the tax return. Well, we can't, but here's great firms that we work with that prepare tax returns and be able to turn them over to a competent, responsive firm that would do that for them. So I'd like to get your guys' take on it, and maybe she left something out, or maybe the article, struck a nerve with you, but I'd like to get your guys' take on this one.
Yeah, I just want to say for me, this one really hits home because I've definitely been, I don't want to say a victim because that is not the right word. I've definitely been part of scope creep in the past and I've allowed it to happen and it's been a challenge for me. And I think one of the pieces of advice that I'm still learning myself that the article didn't maybe mention is to separate. Like in my head, you have to separate your kind of ego about the task that you're being asked to do from the results or what the client might think. And so in other words, you might turn in a work product a week later than the client would have liked to have received it. And you might tell yourself, well, his opinion of me will be judged based on that. But the reality is that that party doesn't always have all the details that might have led you to be a week late on that task. So even though you might be accepting in a demerit on something that you didn't do as well as someone else might have thought, it's not a reflection on you individually or on the task because there's usually more pieces in the background that aren't getting considered in that approach. And so that's one of those things that's hard to accept because for me, it's like if somebody asks me if I can do something, I like to say yes. Like you said, I like to be a pleaser. I honestly believe I can a lot of the times. And then once you get into the reality of doing it, you figure out that what you thought you were saying yes to and what you're actually doing, like you said, aren't always the same. And so, yeah, you have to check yourself in being a pleaser. And you have to realize that they actually are more accepting of that than even you realize. That on the one day when they're upset of something being late, that they look at it again in 2 weeks and realize the bigger scheme of things, that it wasn't actually a judgment on you. And so for me, that's been the thing that has helped me in that issue. But yeah, I'd like to hear Ty's thoughts on it. Do you have any advice on that topic?
Yeah, I mean, I think I have a couple of different thoughts, of course, on this topic, but I would say that, or I will say that not providing a service that you don't provide or saying no that you don't do something, that is not bad service. Or to say it differently, just doing whatever somebody asks you to do, even if it's not within the scope of what you do or what you agreed to do, that's not good service either. And so, I mean, if you put it, and I think, what you guys said is exactly right in the sense that I think this is a endemic of accountants, that there's something about our industry that we want to be all and do all for our clients and be as helpful as we can, and we try to do anything possible for them. But if you think about it, like if you put it in a different context, if a customer walks into a restaurant that serves burgers and does not have chicken anywhere on the menu and never advertises or offers that they're going to serve chicken, they don't serve chicken, they only serve burgers, that's all they do, and that customer then asks the waiter or the waitress or the host or the person at the counter or whoever, can I have a chicken sandwich? And that, so now what do we do? And I think AJ mentioned this. He said, well, you give options. And so good service in that scenario, bad service would be simply saying, F you, we don't have chicken sandwiches here. Didn't you read the sign on the door? What are you asking me for? That wouldn't be good service, right? But running back into the kitchen or finding out if your neighbor upstairs has chicken in the fridge and then, trying to throw it on the grill is not necessarily going to lead to a good service either, right? So the good service would be at that point, AJ kind of suggested this in terms of providing alternatives, saying, well, we don't serve chicken, but 2 doors down on their menu, they've got a great chicken sandwich, right? You should try that. Or if you are like a really high end, and this is the other thing, is that I love, there is a certain service ethic of nothing's impossible. We can do anything. But I think that comes there's a piece that comes after that you have to remember. Nothing's impossible. We can do anything for a price, right? That's commerce, that's business. And so, another way to handle this is if you really are at the level, and honestly, it's fair enough that not every business is going to be at this level of service, being a service provider at this level. But if you really are at the Ritz-Carlton, Nordstrom's or whatever that is level of superstar diamond level service, what you might do in that case is say, well, we don't normally have chicken, but we can send our buyer out to the market to buy the freshest chicken, and then our chef can specially prepare something for you. Normally dinner here takes it takes about a half hour to prepare, but that'll probably take us an extra hour. So it'll be about an hour and a half, and we'll have a special price just for you. Do you want to do it? That's providing an option, right? That could be service as well. I mean, once you say all those things, it sounds kind of outrageous as to provide that service, but that would be another possible option if you're willing to do that level of service. But here's what most of us as accountants usually do, right? What we normally do is what I said earlier is we don't actually serve chicken, but the client asked for the chicken. So we like go and say, oh, well, I have chicken in my freezer at home. Hey, Joe, run down to go to my house and get the chicken out of the freezer. And then Joe brings the chicken in, and then you like slap some chicken sandwich together. Meanwhile, by the time you get, and then that customer who asked for the chicken, there were other people with them. So they also ordered what you do. They also ordered some burgers. But by the time you give them all of their order, the burgers and this chicken that you don't normally do for them, the entire order is taken longer than anything else it's taken longer than your normal service delivery. And they've been sitting there waiting for their burgers, which should have happened pretty quickly, but they didn't get them right away because they're waiting for you to like do this special thing with the chicken. But they don't understand all that. They just know it took extra long to get a burger, which you're supposed to be a burger specialist. So why did it take so long for you to do a burger? And by the way, because your cook was trying to figure out how to do chicken that they normally do, they kind of took shortcuts and didn't make the burger as well as they normally did either. So then what happens? So at the end, then the customer looks at this and they come out of that restaurant and they say, man, for a specialty burger restaurant, the people who had the burgers are like, for a specialty burger restaurant, they weren't that great at doing burgers. And the person who ordered the chicken is like, yeah, my chicken kind of sucked. When that wasn't what you did in the first place, right? But 9 times out of 10, that's the kind of result that you end up with when you go beyond what you intended to do, right? And that's why going that extra mile like that is not actually service in most cases. It's actually, and think about the alternative. If you simply said no to the customer and you said, no, all we serve is burgers. I'm sorry, we can't provide that chicken. But, you could go next door. Well, then suppose that customer then throws a fit, or they say, okay, fine, just give me the burger or whatever. And so then you do your normal service delivery, and it's excellent because you know how to do it. So the burgers are out quickly. Everyone got their meal, very quick. They're very happy with that. The people who wanted burgers are very happy with their burgers because you're one of the best burger makers there are. And when they all leave, the one person who wanted chicken is bad-mouthing you, saying, those effers, they didn't, they couldn't make a chicken. They're a terrible place. What do you think the rest of the customers think about that? Most likely they're not, oh, it's a terrible place because they didn't make chicken. They're thinking in their head, read the sign on the door, dude. They don't make, it's a burger place. They don't do chicken, right? And so I think you have to rely on that kind of common sense in your service delivery and understanding that it's okay to not do what you don't do. And it's not service to like go out and do stuff you don't do for somebody. You're setting yourself up for a problem and creating a situation where you can't provide good service in the areas that you do, in the areas that you do provide good service. So that's my rant on this whole thing.
No, I think besides being really hungry now, Ty, I think it's a good analogy. And I think, when we've talked about it before on this podcast, and I don't know if this is something that a lot of accounting firms do or even accountants, but really soul search and find out what your business offerings are and clearly define them so that you know what they are. I think that's easy for a tax and an audit firm, but it can be more difficult if you're offering different kind of services like our firm, and I think stratifying what you do and for lack of a better word, having a menu of options available so that your employees, your salespeople, and your clients understand what your service offerings are. With the burger and chicken analogy, if you're going to serve burgers, make sure that your customers know that there's a sign that says you serve just burgers. Don't try to make it so, opaque that, or obtuse that of what you're doing. Really clearly define that for your clients and for your staff and for yourself, so that you can know what to say no to and know what to say yes to, and know when to offer an alternative and know when it's something that you can take on. And I think the article really wraps it up in a good way. It says, define your terms, teaches clients how to work with you. You can't make someone respect you, so be selective about who you choose to work with. And I think that's, really true. A good client will understand when you tell them you can't do something or you offer them an alternative from your service. And a bad client will get upset, like Ty's example of the person that was pissed off because a burger place wouldn't make him a chicken sandwich. I think it's true in any business that, I think a good set of clients will understand, when you say no, and providing them a real reason for that, they'll understand and be thankful that you didn't try to perform a service that you're not good at or you don't offer. So I think it's all food for thought. And I think it's something that we've talked about on the podcast before, but really defining what you do and how you do it is essential, even in something as cut and dry as we think accounting is. So. All right, and that's our podcast. Thanks for listening to None of Our Businesses. We're here every week. If you like the episode, leave a like or 5-star rating on your favorite podcast, however you're listening to it. We're on YouTube and your favorite podcasting station. If you're not listening to a podcast, give us a review, a 5-star rating, so that you can help us. And if you're interested in nonprofits, we have a sister podcast called Profitless on Purpose. Make sure to check them out on all your favorite podcasting and YouTubes. But until next time, for all of us at None of Our Businesses, thanks for listening, and we'll see you next week.